When you reach your 30s, life seems to switch to everything at once mode. At first, you're happy about an offer with a salary of, say, $85,000, $90,000 a year. But a month later, you're sitting over your calculator and realize that after taxes, it doesn't look so rosy anymore. Then you open Zillow, see houses for $550,000, $600,000, and catch yourself thinking, how do people even manage this? Money flies away faster than debit notifications. Here is an auto payment for insurance for $240 a month. There are subscriptions, Netflix, Disney Plus, some fitness app, another 100. Some people already have a $1,200 a month daycare bill looming. Others are thinking about future college costs. At the same time, your 401k looks at you like an offended relative. Hey, haven't you forgotten about me? And the strangest thing is that no one explains what your 30s are really like. At 20, they tell you, you'll figure it out. At 30, it suddenly becomes clear that you should have figured it out yesterday. My name is Felix. For the past 3 years, I've been studying this topic and trying to figure out how to help people build capital without living in constant stress. If you feel like your paycheck comes in and immediately disappears, you're in the right place. Let's get one thing straight. I'm not going to lecture you or make you worry about your current bank balance. Some of you have already achieved some of your goals, while others open their banking app and wonder if it wouldn't be easier to earn some extra money on Rover, walking other people's Labradors. Both situations are normal. I just want to talk to you about landmarks, which are like road signs on a long highway. They don't scold you, they show you where to turn. The first milestone in your 30s is to clear your consumer debt to zero. Yes, zero. The only thing you can leave is your mortgage if you already have one. It's better to get rid of everything else in your life. Credit cards with balances, student loans, car loans, that convenient installment plan from Target for the sofa you bought a couple of years ago and are still paying off. Now, many people think, that sounds nice, but my student debt is like the budget of a small city. I understand, but here's the reality. In their 30s, most people experience the strongest growth in income. Their careers stabilize, salaries increase, and bonuses appear. And at this point, debt works like a leak in a tank. No matter how much you pour in, the level doesn't rise. Let's make it simpler. Let's say you spend $350 on credit cards and another $650 on your car. That's already $1,000 a month that isn't building your future, but going to the banks. That adds up to $12,000 a year. Over 8 years, that's almost $100,000. If that same money had been invested at an average of 7 to 8% per annum, the figures would be completely different. It is important to note that by the age of 30, life speeds up and becomes more complicated. At work, it is no longer enough to simply show up. Results are expected. At home, there are bills, groceries, insurance, and everyday chores. Many people have children during this period, while their parents begin to experience health and lifestyle issues, requiring more and more assistance. When you have credit card balances at 20% interest per annum, any unexpected event becomes a problem. Your car breaks down? That's $900 down the drain. You urgently need to fly to visit your parents? Another $400 to $500. These are not rare scenarios. This is normal life. I experienced this firsthand when my mother needed help around the house. She's the type of person who will watch a DIY YouTube video 3 times before admitting that she needs help. As a result, a simple problem with a leaky faucet dragged on for days. Calling a professional repairman cost about $180 and solved the problem in an hour. If I had been up to my ears in debt at the time, I would have dragged it out until the last minute, looked for a cheap option, and fretted over every expense. But instead, I just paid and closed the issue. The next milestone is a credit rating at the bank loves you level. We're talking about the 800 plus zone. Not normal, not acceptable, but a really strong score. I often hear, I don't need loans, so why worry? But if you're not planning to bring a suitcase full of cash to buy a house, your score directly affects the cost of housing. Let's take a closer look. Let's say you're looking at a house for around $480,000, today's average price in many cities. With a very good credit score, the bank may offer, say, around 6.1% on a 30-year mortgage. As a result, the interest for the entire term will amount to approximately $560,000. It already sounds tough, but that's how mortgages work. Now let's imagine that your credit score is worse, not terrible, just average. The rate may be closer to 6.9%. The difference is less than 1%, which sounds insignificant, but in fact, it's already about $630,000, almost $70,000 more for the same house, the same walls, the same neighborhood, just because of a number on a credit report. Sounds unpleasant, right? And the most upsetting thing about this story is that it's easy to ruin your credit score. One late payment of more than a month can drop your rating by more than 100 points and stick around on your report for years. Imagine you had a 790 and now you're closer to 660 because of a forgotten $90 payment. And then you pay more on your mortgage every week for decades. At the same time, the rules of the game are quite down to earth. Pay on time, always. Don't max out your credit cards. It's better to keep your balance around 10 to 20% of the limit. And most importantly, it's better to keep old cards with no annual fees open. A long history works in your favor. A very important milestone is having a substantial financial cushion. At 20, people usually say 3 to 6 months worth of expenses is enough. At 30, that's often not enough. It's more realistic to keep a reserve for 6 to 12 months of living expenses. And if you're a freelancer, work on commission, or have an unstable income, you need even more. Why does the bar rise? Because the scale of problems grows. Your house suddenly needs a $9,000 roof. Your child gets braces that cost several $1,000s. Your car's transmission decides to give up, another $3 to $4K. Plus, situations with parents, flights, medicine, these are not rare force majeure events, but common episodes of adult life. Let's say a family needs about $5,000 a month for basic expenses. The annual reserve is $60,000. It sounds impressive, but it is precisely these figures that give real peace of mind, not an illusion. And it's not just about protection. Money in reserve gives you freedom of action. You don't have to grab the first job that comes along. You can calmly negotiate your salary. You can take advantage of rare opportunities. For example, a profitable real estate purchase or entry into a business with understandable risks. Where should you keep this money? In a liquid place with a normal interest rate. High-yield savings accounts now often offer around 4% per annum. This is not about capital growth, but about ensuring that inflation does not eat away at your savings and that your money is accessible within a day or two. The fourth benchmark is to approach 40 with pension savings at approximately the level of several years' income. A convenient benchmark is about 3 years' salary. Let's say a person earns $70,000 a year at 40. It makes sense to aim for around $200,000 plus in retirement accounts, not as an ideal from the internet, but as a working goal that provides a normal baseline. You might say that you've already been told this, but let's imagine that at 40, you have about $210,000 in retirement investments, and you continue to save steadily. With moderate market returns over a couple of decades, this amount could grow to 7 figures, not because of magic, but because of time and compound interest. It's important to note that if you're behind, it's not a death sentence, but a reason to get more serious. There's still 25 plus years left until the classic retirement age. That's a long time if you start acting now, and a short time if you procrastinate. The most practical move is to increase your contribution percentage along with your income. Got a $5,000 raise per year? Put some of it into investments, not all of it into increased spending. Change jobs for a better salary? Increase your contribution. Got a bonus? Put some of it there too. The difference between saving 12% and say 18% of your income seems tolerable today, But in 25, 30 years, it could mean either a comfortable retirement without headaches or having to work longer than you want to. The fifth stage is to develop protection against lifestyle inflation. This is the line where some people actually accumulate capital, while others simply look successful but live from paycheck to paycheck. It is interesting that in your 30s, your income usually grows, and along with it, your expenses quietly grow. You get a raise, and suddenly it seems logical to move into a more expensive apartment. You change jobs, and it seems like it's time to get a newer car. I've seen people in big cities like Seattle and Austin with incomes of 120 to 150K who still worry about making it to their next paycheck. A $900 monthly car lease, $3,200 in rent, food delivery several times a week, subscriptions, travel. It looks solid on the outside, but in reality, every dollar counts. But don't think this is about living on a shoestring. It's about the moment when your income grows and you need to capture some of that growth in advance. The best rule is to automatically put a portion of each raise into investments and savings. For example, a raise gives you an extra $6,000 per year after taxes. If $3,000 of that goes straight into a 401k, IRA, or brokerage account, you'll naturally adapt to your new budget. Money that you don't see on your paycheck doesn't have time to turn into new habits. The final stage is about something that is rarely discussed in financial videos, even though it has a direct impact on your wallet: investing in your own health. Don't roll your eyes just yet. This isn't a fitness channel. This is a conversation about money, because your body is an asset that either pays dividends or generates bills. Let's take a closer look. Over the course of their lives, most Americans spend hundreds of thousands of dollars on healthcare, doctor visits, medications, procedures, insurance. If you can reduce these expenses by at least a quarter through prevention and healthy habits, that's tens of thousands of dollars left in your pocket. Plus, fewer missed work days, less income loss, and more energy for your career and projects. At 30, many people notice a strange thing. The body begins to remember all its sins. Sleeping only 5 hours a night will take its toll. Eating fast food 3 times a day will start to show up in your test results. Before, you could afford not to think about it, but now your body is presenting you with the bill. And the sooner you develop simple habits, the cheaper they are. Regular exercise, eating normal food most of the time, sleep, stress management, nothing extreme. No one is asking you to live on salad and become a marathon runner. A gym membership for $40 to $60 a month, quality food, sometimes working with a trainer, these are pennies compared to what chronic problems cost later on. The most interesting thing is that your 30s are a period of maximum financial potential. Your income is growing. There is still plenty of time before retirement, but there are also more competing tasks than ever before. How you manage this decade will greatly influence whether you feel calm in your 50s and 60s or constantly count every dollar. These guidelines are not about living an ideal life or competing with others. They're like a navigator. They help you avoid driving blindly. And the good news is that there is still plenty of time to make adjustments. Consistent small actions work just like investments, imperceptibly at first, but then they yield tangible results. And that is exactly how a secure financial future is built.